You can see final minutes of the session, we tested down to the 68 close. That's what I was talking about. Trading ranges, they allow breakouts to get second legs. So if you sold the sell-off down to 68 and you scaled in, we had a two-legged pullback, bears still made money. If you bought here, deep pullback, second leg up. Daily chart. We're forming an inside bar, but fairly late in the rally. That increases the chances that the market is probably going to get a pullback sometime fairly soon. This makes me think that will probably start to go sideways. But strong enough rally, I suspect buyers below them will probably get up to 6,300 over the next couple of days, even if we pull back first. It could take a week or two. But the hesitation and pausing increases the risk that we start to pull back. Weekly chart. Today's the Tuesday, and we have 2 trading days left, and then obviously July 4th on Friday. So far, big bull bar, but small follow-through bar. And I think the odds are against this week forming another strong bull bar closing on its high. And because of that, that makes me think that I think the upside is probably going to be limited. We may have to if we get disappointment, we may get a pullback. So I think the odds are against getting a measured move of last week without getting a pullback first. In the 5-minute chart, coming into today, we gapped down on the open, and bar 1 has formed a tail above the bar, with mostly it being a doji bar after a gap down. Odds are we'll probably test up to the 81 low and the 81 close. Bar 1, disappointment, probably buyers below and sellers above. And then 2 consecutive bull bars, good for the bulls, increases the odds that we may try and find buyers below 1. But as far as doing anything, buying above 1, selling below 1, buying above 2, selling below 2, it's probably going to be a limit order market. Sellers above 2, and buyers below 2, with 3 being a doji, probably buyers below 3. And again, increases the odds that we're probably going to be sideways here. 4, bull breakout, testing the 81 low, good for the bulls. Probably going to go at least a little bit higher, but we have a bull bar closing on its high with 4 at the moving average. And therefore, you have to ask yourself, what are the chances that 5 is another strong bull bar? And then 5, disappointment bar for the bulls. It's a follow-through bar with 4 and 5, and that's good for the bulls. Or excuse me, 5, it's a follow-through bar for the bulls. That's good for the bulls, disappointing for the bears. But it's right at yesterday's close. Probably traders buying, betting on at least a small second leg up. However, consecutive bull bars near a 50% pullback from the sell-off down from the high of yesterday, bar 78, 77 to the low of 1. We may pull back on the next bar. And that's exactly what happened with 6. 6, it's a bear bar closing on its low. Bears, they're hoping that the rally to 7 is a second leg trap. Rally to 3, pause, and then rally to 7. 6, good, decent bar for the bears. But after consecutive bull bars, 4 and 5, bears really need more. But 6 is a strong enough reversal that 7, if it is a high one buy, it'll probably be disappointing. And you can see 7, bulls that bought the pullback from 5 during 6 and 7, they use the rally on 7 to exit back to the 5 close. And that's a sign of trading range price action. 8, inside bar, bear bar closing on its low, but probably going to go mostly sideways here. Not a great sell. 9, outside up, good for the bulls, but an outside bar inside of a outside bar with several overlapping bars, bar 4 to 9, increase the risk that we go more sideways here. So as far as selling above 9, as far as buying above 9, I don't think it's all that great. There's probably some more sellers above than buyers. 10, follow through, good for the bulls, but a small follow through bar. But a small follow through bar increase the chances we get a pullback, and that's what happened with 11. 11, surprise bar, we may go a little bit lower. But as far as selling the close of 11, not ideal, big bar with big risk. 12, testing below 9, but probably buyers below 12. I think the bulls that buy the 9 close and buy the 9 low will probably make money. And you can see they almost did with 11. They bought the 9 close, they bought more below 9 on 11, and the market bounced, testing the breakout point, the 10 low. Bears, 13, breakout pullback sell, so low 1 short, but forcing bears to sell into bottom third of a tight trading range. Really not that great of an environment, and therefore there might be more traders buying below than selling. 14, follow through for the bears, good for the bears. We may go a little bit lower. But my concern is it's already 2 legs down, 12 and 14, and we may find buyers not far below. 15, another bear bar, good for the bears. We're always in short, and the bears arguably short below 13, stop above 13. But if we get a bull bar closing on its high, or if we break above the 15 high by maybe 2 or 3 points, that could easily be enough for bears to give up. 16, another bear bar, good for the bears. But you can see climactic bar on 16, and therefore profit taking. What about buying the close of 16? No, it's still a micro channel, 13 high to the 16 low, and therefore the first reversal up might be minor, but as far as selling the close of 16, really not ideal. 17, bull bar, but now a 6 bar, bull micro channel with an inside bar, increases the odds that the first reversal up will probably fail. But if you're a bull and you buy above 17, odds are high that there's buyers below, but the buyers may not come in until somewhere down here, so it's still tricky. For me, I would not be buying above that bar. 18, outside bar, disappointment bar for the bears, and disappointing for the bulls. Probably buyers below 18, but we may have to fall below the 16 low first. And then 19, reversal up, good for the bulls. Probably going to go at least a little bit higher. The 19 is one of those bars. You have a really strong bull bar, and that's good. And the bulls that buy the 19 close, they want strong follow through. Otherwise, they'll be quick to exit. But as far as doing anything, if I had to buy or sell, I'd buy the close of 19. And you can see what happened with 20. 20 reversed down sharply. And I want to show an example of something. So this was 10:05. Going to be a 1 minute chart. Okay. And you can see, so this is the rally up to 10:05. And you see what happened with the very next bar. So if you bought the close of 10:05 and the market started to go up, look what happened. This is the first 5 minutes. This is 10:06. And then that is 10:07. So the market went from, there we go. The market went from the close of bar 19 down to 42.5, which is right here. So what you don't want to see, and the reason I'm showing a 1 minute chart is it's easier for traders to visualize it. You don't want to see this. You don't want to see the first 5 minutes of this bar go up and the next 5 minutes immediately reverse down. Because what does that tell you? Especially in a trading range, what it tells you is that there's profit taking and there's not a lot of traders desperate to buy, which means there's not a lot of bears desperate to sell. And that's in part why traders started selling out of longs here. Strong enough outside bar, we may go a little bit lower, but I suspect there's buyers not far below. 20 and 21, good for the bears, but still possibly 2 legs down, 16, 21, and therefore there might be more traders buying down here rather than selling. A little bit of an expanding triangle with here and here. 22, bull bar, good for the bulls, always in bears, probably get out, and then follow through 23, 24. But the rally getting high in the range increases the risk that we may get a deep pullback. The bears they had a little bit of a surprise, 20 and 21. And that increases the chances that those bears that sold and scaled in are trapped, and they may look to get out on a pullback. 25, disappointment for the bulls, and therefore loss of momentum, so we may pull back. And that's what happened with 26, 27. 27 tested the breakout point 21, but probably buyers after the rally up to 24. And then the market tried to rally 28, and it pulled back. So that's a trend line break after 26, 27. Low one short, but low probability, probably buyers below. And then we got the reversal up on 29. 29, good enough momentum that we may go a little bit higher. $30, bull bar, I won buy, but I still think we'll probably test back up here, even if we have to pull back first. 31, you can call it an implied low too, with 28 and 31, but probably buyers below. And 32, reversal up, good for the bulls, probably going higher. And then we got the bull breakout 33, but 33, climactic bar in the trading range, increase the risk of profit taking and traders using it to take profits. 34, not a good sell, probably buyers below. And we're probably always in long after the rally, 22, 23, 24, so we may get the measure move up. 34, buyers below, and then 35, scaling in lower. 1 second here. $34, $35, consecutive bear bars, probably going to get a second leg up. And then 36, 3 consecutive bear bars, but it's arguably 2 legs down. Sell off to 35, pause, and then second leg down 36. And therefore, there still could be buyers below 37. 37 reversal up, good for the bulls. Channel's tight, so I still think we'll probably go back up here. And you can see we ended up reaching it after we went sideways to up. 39, 40 bull bars, but getting more, starting to go more sideways. Starting to go more sideways, increases the odds, increases the risk that this is the bear leg and will become a trading range, but magnets above, so probably not a great area to be selling. And then 43, bear bar closing on its low, but every time we've had sudden reversals, we've found buyers. And even though 42 is a strong bear bar closing on its low, I'd rather see what the follow through looks like. It's enough for, do always in bears sell below and always in bulls get out of longs? They might, but it's important to wait and see what we get. It's a possible sell vacuum. And then we got a bull bar 43, not what you want to see if you're a bear. And then more follow through 44. So the bears are getting trapped. It's also 3 pushes down, 37, 40, and 43. So bull bar 43, 44, good for the bulls, may get a second leg up. And then 45, 3 consecutive bull bars, probably buyers below in a second leg. And then 46, another bull bar. Looks like we're going to go higher. And you can see we rallied and broke above the 43 high. 48, series of bull bars, 43, 48. Body's getting smaller, so probably buyers below. And then 49, a bear bar, but not a great bar for the bears after the micro channel, but tricky to buy. You're buying what could be a wedge top. 1, 2, 3 with a lot of trading range price action, and a bull bar 40, bar 50, and then 51 bull bar, good for the bulls, breaking out of the range, but again, this looks like a bull leg and will become a trading range. And then 52 pulled back, and then we got a climactic breakout 53. 53 climactic increased the risk of profit taking, and we're at the magnet, the measured move from the open of 22 down to the close of 24. And then bad follow through 54, 55 outside down, but really not ideal outside bar in a tight bull channel. Probably going to go sideways. And you can see we started to go sideways for several bars in here. 58 touched the moving average, and then we went sideways 59, 60, and ended up finding buyers below, and we reversed up 61. 61, you may have some bulls buying, but it's kind of like bar 19. It's a 50% pullback, and bulls, if they buy, they know it's a trading range, and therefore they want the momentum to happen quickly. And if it stalls for too long, they'll be fairly quick to exit. 62, bear bar, buyers below, so we may get at least a small second leg up. I do think the bulls that bought 61 and more lower probably will make money, and you can see they avoided a loss, 63, 64. But then we just continue to go sideways through these bars. 66, a surprise, closing on its low, good for the bears, but I'd rather wait and see the follow through. And then you can see 67, strong reversal down. So a lot of traders, when they see, it's kind of like the opposite of this. You have a big bar, 19, and I made the comment that bulls will buy. However, if the market rallies and starts to pull back, they'll exit longs. And then bears, what they'll do in a situation like this is bears will sell. And if the market pulls back, they'll exit longs. This sell-off was decent, and the follow-through was pretty immediate, going down in a strong way. And if you remember, this bar, as it sold off, it pulled back and still allowed traders to sell and make money. 67, big bear bar, but it's a fairly big bar with big risk, so probably better to look for a pullback. And that's kind of what happened with 68. 68, low one short, probably buyers below. Bull bar 69, so I think the always in bears probably get out. And then we rallied 70 and 71. Good for the bulls, but two legs down, 58 and 67. So it's a second leg trap. And whenever you get a second leg trap, it's fairly common for the market to test the high of the second leg, 66, and just go sideways and pull back. So even though you have a 3-bar micro channel, 69, 70, and 71, so far buying breakouts today has been really difficult. And if you buy 70 or 71, you've got to have an exit strategy. And therefore, if the market continues, starts going sideways for a couple of bars, it's usually better to exit. 72, small bar, not ideal for the bulls, pausing at the 66 high. And you can see what happened, 73, 74, deep pullback, testing the breakout point. And then we rallied, forming a second leg up, 75, 76. And then we went sideways. Well, technically, we reversed down in the close, reversed down into the close, going sideways. But the bears who sold in here and scaled in made money. For stop entries, maybe buying above bar 4, not ideal. And then, you can sell below 13, not great either. And then what do you do with 19 or 17? I think 17 is okay to get out of shorts, but I don't know if it's great to get out to go long. If you buy above 17, and then you see 19, that's a good bar, but when 20 starts to reverse down quickly, it's better to exit the trade. And then 22, reasonable buy, so bulls can buy that. And then some get out below 26. Bulls, if they get out below 26, they probably buy again, somewhere in here. But tricky, if you get out below 26 and you see the reversal down 27 and then reverses up 28, you'll have bulls start to establish longs in here. And it's hard. If you sell below 26 and you wait for a credible bull bar to buy, you may end up buying a little bit too high in the range. But anyways, bulls that can buy 32, still okay. Buy climax 33. So if you hold long, you're going to get a drawdown. And therefore, it's probably okay for traders to exit below 34 or on the close of 35. But if they do, they probably buy again. Maybe they buy again 37, but 3 consecutive bear bars. There's no harm in waiting for a second entry, 30, bar 40, but still not all that clear. And if you buy above either of these bars, and then you get the rally 41, what do you do with 42? I think a lot of traders, when they see 42 reverse down quickly, they would just take the loss and then look to buy again above a bull bar. Maybe they buy above 44 or the close of 45 or above 46. And then I think those bears probably get out below 55. And then the bulls, where do they buy? Really no credible place to buy. Bears, if they're short, below 55 or 57, maybe they get out couple of points above 60 or above 61. Technically, 61 never triggered, and 63 is probably about more sellers above than buyers. They're not a good location. Bulls, they get out below 66. Bears can sell. And then the bears, they have to get out above 69. And bulls, I think it's okay to buy 69. And then what about here, 73? A little bit tricky. You're buying at, you're selling out of a pullback after a micro channel, and the target could just be the breakout point, 69 high. It's okay to get out and then wait for the hesitation. And then you can see 74, a smaller bear bar compared to 73. Therefore, there might be more traders buying at this breakout point than selling. But then we suddenly reversed up 75. So if you're technically just using stop orders, if you get out below 73, you buy again above 75. But then, what are you doing here? You got to be quick to make decisions. And that's what makes it really difficult. And then bears, if they're really aggressive, maybe they sell 77. But again, I don't think it's all that worth it. For limit orders, buyers below 2 and probably buyers below 6. I thought sellers above the 4 high, especially on the outside up bar 9. I thought sellers above 12. I thought buyers, somewhere near maybe below 15, but not great to buy after a micro channel. I thought probably buyers below 16 during 20 and buyers below 1 during 20 and 21. I thought buyers below 25, but the buyers may not come in until the breakout point. I thought buyers below 28, but it never triggered. I thought buyers below 30 was reasonable. And I thought buyers below the low 1, 38 was okay. And buyers below 48, sellers above 55, the high 1 after a series of consecutive buy climaxes. I thought buyers at the moving average below 59 and 60 was okay. I thought sellers above 63, buyers below 68, but it never triggered. And technically buyers below 72, but the buyer is probably closer to the breakout point, 68, 69 high. And that's a difficult trade. And if you're really aggressive, sellers above 66 high, especially when it closes like 76 does, like this, and especially when it closes this way and immediately sells off. Buy the close, sell the close. Really a bad day for buy the close, sell the close. Maybe sell the close 15, but it's really better to sell the pullback like 19. And even that's hard to do. And then if you buy the close of 22 or 23, what do you do with 26, 27? And then selling 26, 27, not ideal. Bottom third of a pullback after a strong rally, 24. And then, so really, there's really not any great buy the closes. Most of it is wait for a buy the close bar and then look for the reversal to fail and lead to a pullback. So don't buy the close at 33. Wait for the reversal to begin to fail and buy the pullback. Don't buy the close of 45, 46, 47. Wait for the reversal to fail, like 48, and buy the pullback, or 49. Let me take a look at questions. Do you usually stop trading on bar 72? Or do you trade into the close? It depends on the situation. Sometimes I'll stop at 42. Other times I might be more aggressive and trade into the close. But, I want to base the trade based on something logical. But for me, my default is after bar 72. I really want to be cautious and make sure I'm not doing anything just for the fun of it. Because that is dangerous. Okay, question, Brad, regarding bar 69 getting tested was well found. I really struggle to. I keep my limit by there and then gave up. Okay, regarding 69, I'm not exactly sure of the question there. I live in Hawaii. Aside from the New York morning session, what sessions or instruments would you suggest on focusing on to build consistent success in day trading? I think one thing that would be helpful is focusing on higher time frames. And so one of the things that I think is important is focus on things like Forex markets or even 15-minute charts, 30-minute charts of crude oil. Those can be important things as well. But most importantly, it's really important to, let me say this differently. What instruments would you suggest on focusing on? If you're constricted with time and you can only trade a couple hours every day, first off, if you can trade the morning session of the micros or the Emini or something like the SPY, I think that is more than enough. You don't need anything else. Other than that, I would focus on looking at higher time frames. 15-minute charts, 45-minute charts of like crude oil, gold. Forex markets are great. If you look at, here's a 60-minute chart of the dollar yen. 3 consecutive bear bars, 2-legged pullback, bear bar closing on its low, sell below the bar, stop above, and you got a swing trade. Or, if you had a bull bar closing on its high, one of the things I like to look for is, I like to look at swing trades on the open. So sometimes if I'm up early enough, if I'm watching, maybe consecutive sell climaxes, we have a second entry buy, bull bar closing on its high, either buy above that bar, stop below, or wait for the bad follow through, the bad low one here, and then buy the close, stop below. And you could hold it for a swing trade, and the odds are we'll probably get up to the high of this bar. Those are all reasonable things. However, I think the one important thing to talk about, and it's one of the things I've debated about. I go back and forth on it a little bit, but I've debated about whether or not it's worth talking about in Orlando, is trading higher time frames. And I'm actually curious if those of you going to Orlando would really like that kind of a conversation on, how do you trade higher time frames, whether it's daily charts, 60-minute charts, Forex markets. If that's a topic that people would really like to hear, I'm open to giving it. And one of the reasons why I've a little bit thought about it is I think traders naturally have a bias towards timeframes. They naturally, let me say it differently, traders naturally think that markets don't operate the same across different markets or different timeframes. The reality is a 1-minute chart is going to operate the same way as a daily chart. It's the same forces at play. A 60-minute chart is going to operate the same as a 5-minute chart. There's no difference. Let's see here. So here's the dollar versus the franc, dollar Swiss franc. And you can see type bear channel, 3 consecutive bear bars closing on their lows. You can sell the close for a measured move down. We've had a lot of consecutive sell climaxes on the dollar. So if we went something like the euro dollar, probably consecutive buy climaxes. And therefore, around that same time frame, we had a topping pattern and a test down here. So it's getting a little carried away with what I'm trying to say. The main thing is keep studying charts. And I think Forex is great. I wouldn't trade anything less than a 15-minute chart on Forex. And I really want the average bar size to be at least, maybe 15 points if I'm going to trade Forex. That's my overall thoughts. Thanks for your insights on the day. Question: is this the only screen I use to trade, or do I have other screens, charts and assets and indicators? Yeah, for me, whatever I'm doing, I've got other. Let's just put it this way: if I am trading just pure price action on a chart, then I'm just going to use that one thing. In other words, if I have this chart up in front of me and I'm just trading the price action on the 5-minute, I'm going to have this chart and a matrix. Or if I'm trading multi-charts, I might have, some sort of, I might use Chart Trader. But the point is, even when I'm trading, I'm not going to have all of this stuff over here. I'm going to have basically, the very limited things that I really need. And other than that, that's really all I'm going to use. If I'm trading the euro dollar 60-minute chart, I'm just looking at this chart and I'm just placing trades and trying to focus on being very consistent. I think one of the other things that's really, really important is I think it's really important for traders to focus on, trading small. And I think an easy way to do that, a beneficial way, is to trade something like the SPY. Here's the SPY on a daily chart, and this data is delayed. But overall, I think it's a really great market to trade. And even though you look at the SPY and say, well, dang, if I trade the SPY, then and I put you put $30,000 in an account, you get leverage, I think, of 4, so 4 times the leverage. But if the SPY is $618, it's only 194 shares. It's only 194 shares, and 50 shares is the equivalent of 1 micro. That means you can basically trade 3 micros on a $30,000 account. Obviously, that's really not ideal, but I think it's great I think it can give you really good practice and give you a lot of comfort with doing the right thing. And so it's certainly worth considering. Especially if you're just starting out. The SPY moves exactly like the Emini. Let me take some other questions. Okay, sorry, Brad. This was badly written and I could not correct. Bar 69. You said it would be tested, so I said bar 69 here would be tested. Great analysis. I struggled to keep my buy limit there. How are you so confident of the test? Okay, yeah, I see your question now. So basically this person's asking, why did you think bar 69 was likely to get tested? Part of my logic with bar 69 getting tested is one second. Part of my logic with bar 69 getting tested is it's a trading range, and trading ranges, breakout points, close. And therefore, bears who sell the 69 high and scale in, well, guess what? They're going to make money. Just like the bulls who buy anywhere in here and scale in lower, they're probably going to make money. Same thing over here. I made the comment on 24.25. I think I said it in the blog post. My concern was we may get a deep pullback. And the reason for that is breakout points. Bears who sell here, 21 high, 22 high, and scale in, well, guess what? All is forgiven, and they made money with 27. And that is just that's a very common thing that happens. So that's my overall thought with 69 getting tested, is it's a trading range day. So where do we go tomorrow? We have a buy the close rally, and it's a micro channel, but we're starting to get disappointment for the bulls, and we're getting a relatively weak buy signal bar above today's high. And that makes me think that we may end up falling below today's low. As far as getting a strong reversal down, downside is probably limited without more selling pressure first. All right, thanks everybody for tuning in. Hope this was helpful, and I will talk to everybody very soon.